depreciation on real estate is extremely unique in the tax code because it's one of the very few assets that typically appreciates in value during your ownership period. And at the same time, you get to depreciate the cost of it on your tax return. And that's a pretty good write-off. That is unique. You think about a piece of equipment or a truck, the second you buy it, it's now worth less than when you bought it a minute ago. It makes sense that you can depreciate the cost because the value in economic terms is depreciating. Whereas again, in real estate, typically you're getting an appreciating asset and you're still able to depreciate the cost of it against your income taxes. So it's quite a beneficial tax deduction, but it can create some problems later on. The key to understanding depreciation tax-wise is that it is a temporary tax deduction. So you get the tax deduction each year while you own the asset until its life runs out. But when you sell, you basically have to give all of that depreciation back as taxable income upon sale. It's a capital gain, especially for real estate. It's a special category of capital gain that is potentially subject to a higher tax rate than, say, the pure capital gain on the property, right? If we just look at buy and sell, we bought it for 3, maybe we're selling it for 5. So our pure capital gain is 2, but of that 3, we depreciated $100,000 of it, right? So now our gain is 300,000, and that 100,000 is subject to a higher tax rate potentially than the pure capital gain. So that one issue of having to pay back the gain on that depreciation upon sale can be quite a shock to real estate investors who do not realize that's the way it works, that you basically pay it back on sale. So you could have a huge gain when you sell a property and a huge tax bill that you were not anticipating